Hi students, today we are going to discuss the factoring of receivable. In our last video, we covered the provisions related to receivables. So this is the last topic related to receivable factoring. So let us first understand the meaning. Factoring is a transfer of receivable to third party who assume the responsibility of collection. Like say we need the financing or we want to transfer this function to someone who are more specialized in this function. So for that purpose, we are adopting this practice. So in fact, it's actually the sale of our receivable. We are having two kind of factoring. You have to understand very simply. One we call without recourse and another we call with recourse. If a sale is without recourse, so in that case, we are no longer responsible for the collection. In case in future the collection agency not able to collect the payment, so we are no longer responsible. So it's the risk of collection agency. Say I transferred the receivable of 100,000 amount to collection agency, which is giving me the factoring services, and the terms are without recourse. So in this case, we will get our money, and in case the collection company not able to collect these receivables, so it's their risk. We have already covered our risk. Another we called with recourse. In that one, we still remain responsible in case if factoring company will not be able to collect the money. So they will come back to us and they can ask us to pay back this money or we have to renegotiate with them for remaining period of time. So two kind of factoring we are having, as I explained you, the meaning is actually the transfer of receivable to third party, some sort of sale of receivable. And with two kind of conditions, we are doing it with recourse and without recourse. In case of without recourse, we are no longer responsible. We paid the charges to factoring company, we paid the interest. We are no longer responsible in case they are unable to collect. So it's their risk. It's not our risk. With recourse, we are still responsible. We will get our money, but in future, if factoring company not able to collect the money, so we are still responsible. Now we have to discuss one example to understand how the transaction will be recorded in the books in case we are pursuing the factoring. Here we are having one example to develop our understanding, saying a factor charges a 2% fee plus an interest rate of 18% on all cash advance to a transferor of accounts receivable. So these are the initial things like 2% fee they are charging us plus 18% annual interest. Monthly sales are $100,000 and factor advances 90% of the receivables submitted after deducting the 2% fee and the interest. So 10% they are keeping as margin, and on the remaining amount they will charge us the interest, and 2% is the factor fee which will be the total of amount. So here in this arrangement, you can see that 100,000 we are transferring to agency, collection agency. 10,000 is their retention, 2% factor fee they are charging to us. And after deducting first two value, the remaining amount we are having 88,000. On this amount, they can charge us the interest. So as this interest is for 1 year, so that's why 18% we need to multiply with 60 dividing by 360. So like that, we will calculate it exactly for 2 months, 2640. So after making all the reductions, they will remit us 85,360. This much amount they will remit us. So how to record it in the books? The amount we receive from them, cash debit 85,360, Due from factor means this much amount they owe us, they will give us in the future. Like they did not fund us 100%, 10% they are still keeping as retention. 2% in the book you can see is recording as loss on sale of receivable, but you can also record it as like collection charges or some other head, the way we find it suitable. And prepaid interest because we paid this one in advance, that's why I'm recording it as prepaid interest. And the total for all of this, we are giving the credit to accounts receivable. So after this transaction, account receivable will no longer exist in our books. Like normally, how this account receivable arise when actually we did the sale to our customer. So at that time, it booked in our books. But now, as we already transferred to the factoring company, so it will remove from our books as a result of this entry. So here we have to discuss what are the benefits to go for the factoring, and also I'll explain you how the organization use it as off balance sheet financing. Let us first discuss the main reasons why we are going for factoring. As he's saying, factoring company receives high financing fee plus fee for collection, and also they are more efficient because they are specialized in collection. They can help us in collection process. So what's the benefit for us? The benefit for us, we will be able to reduce our staff for the collection. We will be able to reduce our bad debts expenses. But again, when we are going for the factoring decision, we must have to do the cost benefit analysis. At the end, the benefits of each decision should be greater than the cost. It's not like that I am paying more money to the factoring company and other way around, I am not saving the same amount. Also, is help us to make our cash flow better because we will get our money in advance and factoring company will get it after 2 months or 3 months as per the credit terms with our customers. So it's also helpful for us to make our cash flows better because we are getting the finance against our receivables. So here we are having examples like credit card sales are the common form of factoring. Say you are making the payment to one of the supplier from whom you bought some goods. Say he is having a machine to receive the payment through credit card. So what happens? He will pay the commission to the bank for this collection, and now it is between you and bank whether you make the payment to the bank or not. By making the payment of commission, supplier actually received his payment. So this is one of the example for factoring. Credit card sales are the common form of factoring. Now we have to discuss how organization using it as off balance sheet financing tool. Students, in unit one, you notice that we were having few examples for off-balance sheet financing. Like I gave you the example that operating lease is one of the tool we are using as off-balance sheet financing. Special entities concept, joint ventures. One of the thing it mentioned there, factoring of receivables. So here, as we are discussing this topic, so I can make it fully clear for you how factoring can be used as off-balance sheet financing. Let us first understand the word off-balance sheet. See, off-balance sheet financing means we will get the finance, we will get the loan, but this thing is not going to report in our books as liability. So that's why we call it as off-balance sheet financing. So you can see that either it is with recourse or without recourse, entry will remain same. In both of the cases, you are going to give the credit to account receivable, mean account receivable going to remove from the books. So either it is with recourse or without recourse. As I told you, in case of without recourse, you are no longer responsible, but with recourse, you are still responsible. So it's mean it should be recorded as liability in your books. But because of the nature of transaction, it's not recording as liability in your books. This liability only showing in the agreement, only in the agreement which you made with the party, but this liability not showing in the books. That's why this is one of the tool we use for off-balance sheet financing. You know that organizations want to show their liabilities to the lower side to make their financial ratios better. Some companies are using it as off-balance sheet financing tool as well. In the past, if we see the history of fraudulent financial reporting, some companies used it to hide their fraudulent financial reporting as well. Like if we see the history, one of the companies, Zero, they actually did overstatement of revenue. There is one of the strategy we call bill and hold strategy. By doing this strategy, we can overstate over revenue. Like on 28th of December, I'm calling my customer, you need the items. Okay, you need after 2 weeks, I'm invoicing you right now, but items are still with me. So this strategy, we call it as bill and hold strategy. Items are still with me, but I invoice to my customer. So like that, I was able to overstate my revenue. So you know that whenever we do the overstatement of revenue, we will see the sharp increase in our receivables. So just to overcome that sharp increase, they also went for factoring so that they can reduce their receivable and the overstatement of revenue will not be traced out. Somehow one of the whistleblower identified it and they traced out. All right, students, I hope that you are clear about this concept. And if you are having any confusion, you can mention in the comment section. Thank you very much.